As someone who's constantly on the hunt for higher yielding investments, a common question I hear is, how high of a yield is too high before a dividend stock becomes too risky? And that's a really difficult question to answer because it all depends on the type of investment. For a business development company, these typically yield around 8 to 10%. Closed-end funds offer anywhere from 6 to 12%, and many covered call funds offer around 10 to 12%. This, in my opinion, is right around average for these types of investments. But there seems to be something about a stock or a fund offering a 15% yield that some investors seem to look for. And although there are possibilities out there for people seeking a 15% yield, the real question is, are any of these investments actually good? When it comes to investments that do reach the 15% threshold, there are a few options available to investors, but as you can imagine, many of them do come with a very high amount of risk. For starters, one category of stocks that occasionally offers a 15% yield are mortgage REITs. These are companies that either issue their own residential or commercial mortgages, or they invest in pools of already existing mortgages. Additionally, some REITs will also hold other types of real estate securities like mortgage servicing rights, or they invest in both real estate securities and physical properties. All REITs are required by law to pay out 90% of their earnings to shareholders in the form of dividends, which is why so many of them offer higher dividend yields on average compared to, say, consumer staple stocks and other kinds of holdings. There are a number of benefits to investing in REITs, which include exposure to a sector that's very hard to invest in, which is mortgages and mortgage-related securities. But it's important to note that not all REITs are created equal, and that some have far better track records than others. It's also important to know all the risks involved in investing in these kinds of stocks. Most mortgage REITs do struggle a lot during periods of high interest rates, like what we're going through right now. High interest rates make borrowing money much more expensive, and it reduces the net interest margin for these companies. They also see reduced net asset value on their holdings, which also leads to a lot of reduced income. Because REITs usually trade around their NAVs, their share price will fall along with them. To look at some examples, one popular REIT that's yielding over 15% is AG&C Investment Corporation. This company invests in residential mortgage pass-through securities for which the principal and interest payments are guaranteed by U.S. government-sponsored enterprises or U.S. government agencies. The stock yields 15.67% and it even pays monthly dividends. But if we look at the dividend history for this stock, we can see 3 dividend cuts in the last 5 years. Additionally, the stock has lost over 51% of its share price in the last 5 years, which shows that it's a very high-risk 15% yielder. Another company that offers a huge yield and does the exact same thing is ARMOR Residential, ticker symbol ARR. You can also see multiple dividend cuts to this stock in the last 5 years, and the share price for them is down 78% in the last 5 years. There are a couple more REITs out there that yield 15%, but almost all of them look like this. So although there are several options available, a steady 15% yield in this sector is usually unlikely. I've seen steady 10 to 12% yields, but 15% is a little too high. But another investment type that offers a 15% yield is CLO funds. These are closed-end funds that hold collateralized loan obligations, which are securities that hold a pool of various corporate debts. The debt that's inside CLO funds is often very poorly rated or even unrated, so financial institutions will bundle these debts together to help minimize risk. As you can imagine, the odds of defaults are much higher for these funds, which is the primary risk of these holdings. Additionally, all these funds come with extremely high expense ratios, with some of them topping 13%. There's currently 4 CLO funds in existence, and they all offer yields that top 15%. But just like mortgage REITs, they all suffer from a very similar phenomenon. Over time, their share prices collapse, and their dividend amounts often follow suit. The most popular CLO fund is Oxford Lane Capital, ticker OXLC. Since their IPO in 2011, their share price has fallen by more than 73%. They've also reduced their distribution amounts on a few occasions, despite increasing it a couple of times as well. Another popular CLO fund is Eagle Point Credit Company, ticker ECC. This one's actually done better than OXLC, but its performance still hasn't been great. You can see a steady decline in their share price over the years, and they've also cut their dividends a number of times too. Although some of these funds have performed better than the REITs we looked at earlier, the share price erosion is a pretty concerning issue. But a third option for seekers of high income who also happen to have strong stomachs is to also consider exchange-traded notes, or ETNs. They're a pretty unusual type of investment that combines the features of both fixed income securities and equities. ETNs are unsecured debt securities issued by banks that typically hold commodities. The return of ETNs are linked to a market index or some other benchmark. One difference between ETNs and ETFs is that ETNs don't actually own any of the assets inside them, whereas ETFs do. There's a lot of ETNs that are publicly listed on exchanges. Most are tied to the performance of oil and other energy indexes, but some are also tied to other commodities like gold and silver. Most of them are also very thinly traded, which means they're not really worth buying in my opinion, plus not all of them appear to pay dividends consistently. But the most well-known and probably the most traded ETNs out there are the ones issued by Credit Suisse. They have their own line of ETNs called the X Factor Exchange Traded Notes, and they all offer pretty high dividend yields. The two highest yielding ETNs they offer are the Credit Suisse Silver Shares Covered Call ETN, ticker symbol SLVO, which currently carries a dividend yield of 18.23%. And the other one is the Credit Suisse X-Linked Crude Oil Shares Covered Call ETN, ticker symbol USOI. You can see this ETN pays about $31 a year in dividends, which is insane. But there's two things people need to keep in mind about these investments. Much like everything else we've looked at, their share prices have also kept falling over time. You can see USOI collapsed during the pandemic, but afterwards it did stabilize for a little bit. But since then it's been falling every single year. It's currently down over 33% over the last year alone. Things appear to be going even worse for SLVO because not only is it down a whole lot over the last year, but its yield is significantly lower than USOI. But if you remember what I said earlier about needing a strong stomach for these, I wasn't just referring to the falling share prices. That's because ETNs also come with delisting risk, which means the financial institutions that issue ETNs can choose to delist them anytime they want to. This can cause a lot of chaos for investors who happen to be holding on to these during the time the bank announces their delisting. I actually used to be a shareholder of USOI for a while, but I decided to sell all my shares when Credit Suisse was facing some very serious difficulties. I sold all my shares before UBS announced that they had agreed to buy the struggling firm. So if you do decide to invest in either of these, that's just going to be a risk you'll have to take into consideration. Finally, there are a few sectors out there that can offer 15% yields, but not consistently over long periods of time. For example, it all depends on the demand for their products or their resources. A good example of this would be royalty trusts, which have specific periods where they can offer dividend yields upwards of over 15%. When the price of oil is really high, then royalty trusts pay out massive dividends, but when demand isn't as high, then they can drastically cut their dividends or not pay any at all. One company is San Juan Basin Royalty Trust, which currently offers a huge dividend yield as you can see. But look at their dividend distribution history. We can see when oil prices shot up in 2021, then SJT started paying these massive dividend distributions. But before 2021, when oil prices weren't so high, the stock hardly paid any dividends. So with this in mind, royalty trusts really aren't the kind of stocks you'd want to buy and hold for decades at a time. They can be used to collect high dividends during very specific periods though. Another sector that sometimes pays high dividends are shipping companies. Again, for these stocks, it all depends on the demand for their services, and they can quickly cut their dividends when things take a turn, like an economic slowdown. Zim Integrated Shipping is a good example of this. You can see it's been paying really high dividends for a while, but their share price has fallen more than 70% in the last year. It's a pretty good indicator that the market's been more pessimistic about this company with all this talk about an economic slowdown on the horizon. But besides what we've looked at, there are a few outliers where you can find a 15% dividend yield. You might find an equity REIT here, a business development company there, and a few ETFs that typically use covered call strategies and so on. But if there's one thing we've learned from looking at these ultra-high yielding investments, it's that they usually suffer from deteriorating share prices and dividend cuts, or they only offer high yields when the timing is right. Most equity REITs offering a 15% yield are usually involved in either a scandal or a short attack, or their business is performing so poorly that investors are selling their shares and driving the price down. It is possible to buy a good investment offering a 15% yield, but the opportunity is usually very brief. As I'm sure most people watching have heard, you should never just invest in whatever you can find that's offering the highest yield. It's easily one of the most common mistakes people who pursue dividend investing make, especially income investors when they're brand new. You want to make sure that what you're investing in doesn't have a long history of dividend cuts. I'm sure a lot of us watching dream of living off dividends at some point in our lives. You want to make sure that you check out the dividend histories of the companies you invest in to make sure they aren't being reduced as time goes on. With that being said, that's going to wrap up today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.